The US-China rivalry, a $1 trillion shock to the economy? For years, the ongoing competition between China and the United States has commanded global attention. Recently, however, the clashes have taken on a more intense and impactful tone. With stakes higher than ever, these tensions are influencing global markets, shaping trade dynamics, and raising questions about the future of the world economy. This video delves into the nuances of the US-China rivalry and unpacks whether the reported $1 trillion shock to the US economy is a symbol of broader vulnerabilities or an overblown headline. The tech-heavy NASDAQ and other global stock indices have been shaken by the escalating conflict, fueled in part by China's advancements in artificial intelligence. On one end of the spectrum, the United States, adhering to policies like Donald Trump's America First, strives to retain its global dominance. Meanwhile, China continues to assert itself as a major economic force, doubling down on production, exports, and technology investment. The rivalry has escalated into tariffs, targeted sanctions, and high-stakes diplomatic plays, with the consequences of these maneuvers reverberating through the global economy. Reports now suggest that financial turbulence in the U.S., accentuated by China's strategies, may have contributed to a $1 trillion gap in the American economy. What does this figure mean? More importantly, what lies ahead? When President Donald Trump declared a trade war on China, the goals were straightforward: diminish the trade deficit, protect American workers, and slow China's growing influence. These ambitions led to tariffs on Chinese goods, restrictions on US-China business relationships, and incentives aimed at bringing manufacturing jobs back to American soil. While the priorities reflected America's economic insecurities, they underestimated China's capacity to adapt. In retaliation, China countered with policies directly affecting American farmers and producers while solidifying trade partnerships in the Asia-Pacific region. The global supply chain buckled under the strain, and U.S. consumers faced rising costs. Instead of gaining an upper hand, the U.S. seemed caught in the crossfire of its own trade war. One of China's most striking tactics involves reducing its holdings of U.S. Treasury bonds. This shift has driven up Treasury yields, adding to the cost of U.S. public debt, while momentarily shaking market confidence. Coupled with algorithmic trading amplifying price fluctuations, financial analysts are left debating what impact this adds to the supposed $1 trillion setback. Beyond Treasury bonds, China's ability to work around trade restrictions, leveraging its capital mobility alongside its trade surplus, has fostered further financial disparity. This methodical strategy continues to unsettle financial analysts, underscoring the interconnected weaknesses in the U.S. economy. Even with its challenges, the U.S. remains the world's largest economy, driven by its technology leadership, innovation, and immense consumer spending. That said, cracks in America's economic armor are becoming harder to ignore. With public debt at record highs and rising interest rates pushing refinancing costs, experts warn of risks on the horizon. If China and other foreign holders of U.S. debt accelerate their withdrawal from Treasury bonds, the repercussions could manifest in deeper fiscal strain and slowed economic growth. Long-term risks, including recessions or widening trade deficits, seem tangible enough to keep economic discourse alive. The $1 trillion figure may not spell imminent doom, but it highlights the fragility of current US-China financial dynamics. Donald Trump's calculated stance in the trade war banked on the perception that the US could dictate terms unilaterally. What he overlooked, however, was China's resilience amidst sanctions. With little room to waver, China fortified its economy, increasingly looking inward while strengthening its global partnerships. Now, as tensions between the two nations flare, the global economy is presented with two potential paths. A compromise, a trade deal or financial accord between the US and China could foster stability in financial markets, allowing economies worldwide to breathe easier. Fragmentation and intensifying rivalry might pave the way for a divided global economy, where the US and China lead separate blocks, each with its own trade rules, economic policies, and tech ecosystems. Challenges abound for both nations as they test the limits of geopolitical power and economic adaptability. Even as they vie for influence, the reality remains: a world divided cannot grow as harmoniously as a world united. This US-China conflict transcends mere trade figures, it's a battle over the future of global economic leadership. Whether the rivalry concludes with a truce or perpetuates a fractured global order, the fallout will affect everyone. From market-driven anxieties to disrupted supply chains, these two economic giants are redefining how the world does business. While we pay attention to reports of $1 trillion economic losses or rising Treasury yields, one thing remains clear: this isn't just about numbers. Instead, it's a narrative about resilience, competition, and the delicate balance of maintaining influence in a rapidly changing global economy. As today's developments unfold, the world watches closely. What do you think lies ahead for the US-China rivalry? Leave your thoughts in the comments below, and don't forget to like, subscribe, and share this video to help us explore more pressing global topics in future episodes.